So good evening to you once again, and welcome back to JPS Tutor, and also welcome back to Financial Management class. So I still remain your humble tutor, Ahmed Sadiq ACA, and we'll continue on our journey where we stop. Though we know that in between our last class, the Institute released the new ICANN study test, and of which we have already give ourselves assurance that based on the study material that we have with ourselves, even if they release something, that it won't be materially different from what we have. And for those of you that have the current material that we are using, so when you compare it with what is being released by the Institute, you can confirm that there is no any material changes. And on our previous class, we have explained the importance of financial management and the functions that financial manager perform in an organization, starting from making decisions on how to invest in a particular project, investing decision, going for how they are going to finance that investment, which is financing decision, and also the issue of dividend sharing, whether to declare dividend or not, and if at all they are declared the dividend, on which percentage of the profit or retained earning that is going to be ploughed back to the business for the business growth, and also the one that is going to be sharing to the owner of the equities, the ordinary shareholders of the company. We discussed that, and we also talk about the risk management, which is some theory. I include the risk management activities as the fourth part of the functions of financial manager, while some believe that the risk is being embedded within the three functions, which is investing decision, financing decision, and dividend decision. And going on our recap of the last classes, we have tried as much as possible to decode some of the rationale behind the financial management and what we are expected to achieve, and the approach or how we are going to tackle any questions. So based on the ICANN syllabus, we know that the core competencies, the main core competency of this course is divided into two: the investment part and financing part. So if you have go through the new ICANN syllabus, so you can see that they talk more about investment appraisal, the net present value. So last time I gave assignments, so it is only one person, if I can recall, that submit his assignment to me on that net present value. I know we work out on the payback period, accounting rate of returns. So I don't know. I don't think we did a net present value in the class, but I gave it as an assignment. It's only one person that submitted that to me, and that is the main competent area that you should be expecting your main questions, your number one questions. So, and also I said the core competencies being divided into two, right? So we also have the financing parts, so which is talk about how the company is going to raise finance for its projects. So that is why you will be dealing with valuation of companies if you want to take over any company to value a company. And we have different model like capital asset pricing model. So we have net present value model. So those are the things that we look at. So, but today, when I check the syllabus, or let me say, the study test, rather, the new study pack that is being released. So, when I check, I go through from what we have done from like chapter 1 to chapter 5. So, some of the things that I think that we need to refresh, starting from chapter 1, so that we can be at the same uh, page, and also to help those that they have not been participated in the previous class, so to also benefit on what we have done. So on the chapter 1, you can see that after they explain the function of financial management and they talk about so sorry, I have a network disruptions. So as I was saying, we are going to be looking at financial performance, how we can measure the financial performance of the businesses. Yes, all the financial performances of the managers, because they are the one in charge of how the finance activities of the company. They are the one in charge of management. So we are going to be looking at this financial performance, and we are going to be looking it at the angle of the investors or the shareholders. those that provide the funds for the business. So you remember when we are doing our cost of capital, I say we can look at it in the angle of the company, and also we can look at it in the angle of the investors or the shareholders. So the shareholders provide the funds for the company to invest, and the company, they are in terms of the management, they are the one that's making the investment decision. So before the shareholders or the investor can also provide money for the business, they also have to do their own performance, checking the financial health of that company to see that if it is company that is in line with their own objectives. So you understand. So we have, let me start and share my screen. So I believe the question that I sent to the group, we all have it with us. So let me also share my screen. So I'm sharing my screen now. This is the question that I shared to you, and I believe that you should have it as well. So let's go straight to the requirements. So this is the 3 major performance indicators that the shareholders or the potential investors that they are going to use to assess the company, to assess the financial health of the companies. So for them to decide if it is current shareholders, whether to continue leaving its investments with that company, or if it is potential investors, whether to invest or not to invest in that company. So this is like 3 main financial performance indicators for the investors that they will use to assess the company. So if you check the chapter 1 of the new study test, so this question has been extracted from that chapter 1. You can see that they do it differently. So, but I have compiled everything together as a single questions. So this will just be a walk away for you if you are going through the study test. So we are going to be looking at return on capital employed, earning per shares, and dividend per shares. And also, we are also going to be looking at total shareholder returns, TSR. So these are the 3 major performance indicators for the shareholders of the company to assess the health of that organization. So before we start the question, let's be interactive. Let me be assured that we are at the same page. So I would like anyone that is going to explain to us what do we understand by return on capital employed. So what is returned on capital employed? So can anyone give us the explanation? All right, Rejoice.
Okay, thank you. From what I understand, that capital employed is like the returns you get from your business after you bring out money to start a business. Then you now make your deductions like expenses and costs. So the total is the returns you get. I don't know if it's That's what me I understand. Thank you.
All right, thank you so much. So returns on capital employers, when you invest, what you are expecting back as your return from your investments. Any other person that can contribute to what Rejoice has said? Any other person? Gayos, are you there?
Yes, I'm here.
Okay, can you add to what Rejoice has just said?
I think I can try.
All right, go on.
Okay, so capital employed refers to the total amount used by a business to generate profits. And the formula for capital employed is total assets minus current liabilities. Thank you.
All right. So thank you, Gayos, and thank you, Rejoice. So that's good. So both of you are correct technically. Yes, I think Gayos gave an appropriate formula. So, and if we are going to more advanced, but we don't need that now. Yes, but at our stage, the formula that he gave is accurate and it is very correct. So return on capital employed. So, we have different in time of that performance, profitability measurement, like return on equity, return on investment. So it's just like from the angle that we are going to see them. So the formula will be slightly different. But I don't want us to be like debating. Let's just like concentrate on what we are discussing in the class. So return on capital employed. So based on the money, let me start from the explanation of Rejoice. So based on the capital or the money that one or the business has been invested. So what is their return? What they are going to earn from that money? So for instance, we can view it like if you give like 5 million deposits, fixed deposit in your bank account, and they give you maybe 20% interest. So that 20% is your return, and that 5 million, your money that you have been deposited in that bank, so is your capital employed. So something that is generating money for you. So the return on capital employed, when we are doing the work, I'm going to show the formula. So we be profit before interest and tax. So divided by ordinary shareholder plus reserve plus preference shares and plus long time loans. So if you add everything together, I believe we're all conversant with all these accounting terms. So if we had all these things together, you can see that from the other side of our balance sheet of statement of financial position, it is only current liability that is being excluded. So, and we know that total asset is equal to total equity and liability. So if we say total assets minus current liability based on the definition of Gaius, so we are going to also get the same thing. I think I'm communicating clearly, right?
Yes, sir.
All right. So the only thing I give a comma that's based on our situation now, because when we are dealing with maybe complex accounting or group accounting. So you have minority interest, all this. So you cannot just say total liability minus current total asset minus current liability. So that is it. So any per shares and dividend per shares. So anybody that's going to explain any per shares for us is also going to explain dividend per shares. So I know all these things, something that we all familiar with. So, but I want us not. I know some of us in the exam, if they ask you, you can write it based on what you read. But I want a deep understanding, because my method of teaching and my purpose is like to be building on our previous knowledge, on what we have learned. So I believe by so doing that we are going to improve a lot. So in terms of our assimilation and the time that we are going to learn something, because what you have learned now, if you are going to professional level, you are going to write your strategic financial management. So if you see all this, it just, even you can skip it, or you just read it for revision. So if you know this thing very well, it's like you are reducing 50 to 70 percentage of your reading time when you go to that period. So any per shares and dividend per share, who is going to volunteer to explain that to us? All right. Temitope.
Okay, sir. Good afternoon, sir.
Good afternoon.
Any per share is what you're making, what the company is making on a share, while the dividend per share is like what the shareholders are receiving on one one share.
Yes. So that is concise and straightforward. Any per shares return on each shares, and dividend per shares, what is being given to the shareholder based on the each shares that they hold in the company. So we say that the three main functions of financial managers is also a dividend decision. So when they have positive earning per shares, then they are going to decide that whether to share part of it, or to share all, or to not share at all. So the last one, total shareholder returns. Total shareholder returns. Any volunteer? We don't have time. Oh, we are still going to do working. I want us to be quick as much as possible. Let's do this thing sharp.
Okay, sir. Total shareholder returns is just like the total value of an investment in a company stock. That's and that one, and it includes both the capital gains and dividends. So it's more like a comprehensive measure of a company's financial performance and success rate. So,
The,
and I think, yes, sir.
all right, thank you. Adepoju, right? So that's very fantastic. So I'm happy now. So I believe we are all making efforts. Yes, because in a company, what will be the shareholder returns? We have said that the main objective of the company is to maximize the shareholders' return. And what will be the shareholder returns over the period is the growth in the shares, or let me say the growth in the share price, and the dividend that is being given to the shareholders. So if you invested, currently now, when they increase the capitalization margin for the banks, So they issue new shares, and most of us are invested in each respective bank of our choice. And our expectation is to the dividend that we are going to be receiving and the growth of that shares. Maybe when we invested is 15 naira per shares. So we are expecting that in the next 5 years that shares maybe it should reach 50 naira per each or more. And also over those period want to be receiving the higher dividends. So total shareholder returns is the dividend that is going to be received from the company and the share growth of its investments. So that is very good. So I believe based on what I've seen today, I'm even happy. I know that as far as this thing is concerned, theoretically, and also I believe if it is calculation side, we should be able to do it with this level of our understanding. So this is our question. So as usual, so we are going to have the volunteer to read the question for us. So who is going to do the volunteer? Let me call this question. All right. AGK, yes, you can read the question for us.
Alpha Cement PLC. Hey, I can't see the question anymore. Okay,
All right.
Alpha Cement PLC, a leading manufacturing company, experienced significant growth in 2024 following major capital investment and expansion of operations. The company summarized financial data as at 31 December 2024 is presented below. 1 January 2024 down to item share capital. The share capital for January 1st, 2024 is 1 million, and that of December 31st is 1 million. So share premium for January and December 500,000. Accumulated profit is 2.5 million. Additional information: profit before taxation is 1,050,000. Taxation is 375,000. Profit after tax is 675,000. Interest charges on bank loan 150,000. Dividend paid 225,000. Sales during the year 29 million. Number of ordinary shares 1 million shares as at 1 naira each. Share price on 1st January 2024 15 naira per share. Share price on 31st December 2024 17 naira 25 kobo per share. Dividend per share during the year 0 naira 75 kobo. Required: based on the information provided, calculate the following key performance indicators for Alpha Cement PLC for the year ended 31st December 2024. Return on capital employed using profit before interest and tax and average capital employed. 2. Earnings per share and dividend per share. 3. Total shareholder return, clearly showing both the capital gain yield and dividend yield.
All right. Thank you so much, my brother. So now, before we start, I want to quickly do something that is something technique. So if I change this figure in comma, I change it, let me change it to 2.5 naira each. 2.5 naira each. So for this now, this share capital now, the value is 1 million and they are 2.5 naira each. What will be the number of shares? Rejoice. What is the number of our shares? Anyone that can help? Maybe Rejoice is not with us. Adepoju.
Sorry, sir. Can you please take the question again, sir?
All right. So I change the share capitals. This is 1 naira per share. So I change it to 2.5 naira per share. And our total value is 1 million naira. So I'm asking now, what will be the number of shares for this company? So now,
Okay, sir, 400,000, sir.
400,000. So I believe you are correct. $400,000. So I just bring this issue because sometimes most of us will just believe when you see 1 naira that everything is just 1 naira each. When you see the value like this 1 million, you believe that the number of shares too is 1 million. So and sometimes we don't used to pay attention to the share price per shares. So it is very important. We may have 50 kobo each. We may have 75 kobos. So you should be able to know the number of shares. So that is one of the things that will be noticed. Because sometimes when you see the question, I used to emphasize it fairly simple. There may be something that is very tricky inside that you will not know unless you are very careful on that question. So let's start from our question one. We are going to find return on capital employed. So let me copy the formula for us. So I'm going to share my so this is the formula for the returns on capital employed. Profit before interest and tax divided by average capital employed multiplied by 100%. So let's quickly break the formula down. Profit before interest and tax. So we know that. And why is profit before interest and tax? So you know that the owner of the capitals comprise the shareholders, so which we are giving the dividend, and also the loan provider, the long-time loan provider, which used to receive the interest. So now those are the two parts that made up our capital that contributes to the capital that we employ in the business. So now to find their returns, so we need to bring the interest back because it's part of the returns, since one part is collecting interest as their returns. So if we are find ROE, I made mention of it earlier, ROE, return on equity. If it is return on equity, it's only for the shareholders. So our formula will be profit after tax. Okay, sorry, profit, yes, profit after tax. Yes, profit after tax. because for the equity holder, it is after you have paid the interest and tax before they can get their returns. So I think I communicate clearly here. So if it is return on equity and our divided by equity, so it will only comprise the shareholders and the reserves. So now let's go to our question. How are we going to get our profit before tax? Okay, profits before interest and tax. How we are going to get it from our question? So we have profit before tax here, 1,050,000. So we have profit before tax, which is 1,050,000. So we are going to look at the interest. What is our interest? Okay. Interest charge on bank loans. So this thing, I don't want to be going too deep. For this question now, it is very clear. And that is what we expected, the normal question that is going to be coming in your exam at. That interest charge on bank loan. Your interest may comprise other things like bank maintenance fees, normal bank charges, and other charges that is not related to the long-time loan providers. So if it is comprised that, we are going to remove it. But this is very clear. Interest charges on bank loan, 150,000. So the interest is 150,000. Okay. I lost my connection and I didn't aware early. So please let's confirm. Are you with me up to this stage? All right. So that is very good. So we have complete our profit before interest and tax. Now we want to find out our average capital employed. So this average capital employed, the formula, they will say that it is good to use the average capital employed. But if you cannot find the average, you are going to use just your capital employed. So if they give you the opening balance and closing balance, balance at the beginning of the year and the balance at the end of the year, then they are expecting you to use average capital employed. But if they only give you one information based on our question here, so maybe they just give you this, so you will just use capital employed, or they only give you this. But if they give you both, they are expecting you to use the average. And how you are going to get the average, you are going to add the opening balance and the closing balance together and divided them by 2. So this is our share capital, is part of the equity. Share premium is part of the equity. Accumulated profit is part of the equity. Bank loans. So these are our total capital employed at the beginning. This is our total capital employed at the end. So let me say capital employed at the beginning and capital employed at the end.
Albania. You ever been? Nope.
I can say my average. So capital employed at the beginning.
What? Fucking pies. Honestly.
5,000. Please, who is that?
Sounds
Can you unmute yourself? So capital employed at the end, which is 7 million. So the average now will be 5 million plus 7 million, then divided by 2. So our average is 6 million naira. So to use our formula now, our ROC, return on capital employed, I want to put equal to what is our profit before interest and tax? 1.2 million. Let me use my formula. And what is our average capital employed? Okay, it's multiplied by 100%. So what are we expecting to have? Will be equal to this divided by this multiply by 100%. So our return on capital is 0.2. When I change it to percentage, it's going to give us 20%. So our ROC percentage, our ROC is equal to 20%. So any question? Do we understand this? Is this clear to all of us?
Yes, sir. It's very clear.
That's very good. So, and I believe based on our explanation, even if you see something that is slightly different, maybe they give you information for the opening or closing, you know how you are going to solve your way. So this is very simple as far as you understand the concepts. So we are moving to question 2. What is our question 2? We are going to find. Okay, Sulaiman, you can speak.
Okay, thank you, sir. My question is the translation of this 20%. Does that mean in every 1 naira of their share, they are earning 0.2, or there is something different from my understanding?
To interpret this indicator is based on capital employed, not on their earning per se, on dividend per se, which is second question that we are going to solve. So what this thing means is on the total capital that is being employed in this company, they are being able to generate 20% of their capital employed during the year. So that means, for instance, so if you have used 10 million as your investment, maybe you invest on pure water factories, the 10 million you buy machine, building, everything that you are using as your capital there. So, and at the year end, when you calculate your profits, so you are able to make 2 million as a profit. So that 2 million now is 20% of the 10 million of your capital that you used to invest in that company. So if you want to calculate your return on your capital employed now, it's going to be that 20%. So based on my early explanation, it's the same thing like you give fixed deposit of 5 million in the bank, and it is giving you 20% interest annually, which is 1 million. So that means that is your return on your investment. That is how you will interpret this. So is that clear?
Yes, sir.
Yeah.
Yes, sir.
So let's move to earning per shares and dividend per shares. So we have explained earning per shares and dividend per shares. So what's important now is the formula. Our formula, and all these formulas, it's not even something that maybe you just have to put on your head or something. If you just need to understand the concepts, and anytime you need it, everything will come. So let's start with our earning per share. Let me paste the formula somewhere here. So this is the formula for our earning per shares. And you can see the formula is being written basic earning per shares. So the earning per share is also being divided into basic and diluted. But as far as we are concerned, the scope of this course is only on basic. So when they are saying earning per share, so they mean basic earning per shares. So in some cases, we have diluted earning per shares. And the reason why we used to have this diluted earning per shares is during the company acquisition or mergers or any potential investors that just want to invest in the money. We say that the earning per shares show the earning capacity of the company. Like per each shares, what am I going to be getting as my return? Based on the question that Suleiman asked. So if the potential investors or the acquirer calculate the earning per share based on the number of ordinary shareholders in the company. For instance, if the company is making 2 million and they have 1 million ordinary shares with 1 naira each, so that is 1 million number of shares, and they are making 2 million. So you can see that their earning per shares now, like each share will be making 2 naira as earning per shares, because number is 1 million and they are making 2 million in a year. So their earning per shares will be 2 naira per shares. So, but in the situation of merger and acquisition, a company or a company may have some long-term loans, like the one that we see now when we are calculating our total capital employed. And this long-term loan, they are into different categories. They have different terms and conditions. So we have secure and unsecure, floats on floats, and where and when is we have what we call convertible, especially if it is bond. We have convertible bond. So if you have convertible bond, it means that the owner, the bondholder, can convert his bond to the shares of that company at a predetermined rate in the future, if they want to do so. So that means if we have like 5 million bonds and they are convertible, if they decided to convert their this thing, they take that options to convert their bond to shares, that means the number of shares now will be more than 1 million. And with current profit, so that means the earning per share now will decrease. So that is why sometimes they will add those convertible bond to the number of ordinary shares. So they will assume the number of ordinary shares they're supposed to get, assuming that they are converting into shares, and they will add it to the number of ordinary shares. So that will be the number of ordinary shares that they are going to use. They call it diluted earning per shares, but that one you are going to meet it in your SFM. So basic earning per shares is equal to earning per shares that we are discussing here. That is just the points that I want to make. So, and the formula, profits after tax attributable to ordinary shareholders, and weighted average number of shares. So another thing that you need to know from your financial accounting, the difference between preference shareholders and ordinary shareholders. So after profits, after tax, if you have a preference shares, you need to give them their own rate first. So that is another thing. And the remaining is what is attributable to ordinary shareholders. And that is the profit that we need, divided by weighted average number of ordinary shares. So you can make your formula very simple. Just say that number divided by number of ordinary shares. The weighted average number of ordinary shares, too, I believe that it is beyond your scope now, because this weighted means that during the year, maybe the company is issue shares, or yes, let me put it like that, the company is issue shares. The person that has bought the share in January and the person that bought its own shares we are in September now. In September, you cannot expect them at the December when they are declaring the dividend for them to get the same amounts. It has to be correlated with number of period that is being spent. So when we have different dates of subscribing to shares by different shareholders, then we give them the weighted average. So the person that subscribed in September now, we only have 4 months or 5 months to the December. So we are going to say 5 divided by 12 multiplied by the number of shares that person acquired. That is what we are going to record it. Assuming that he acquired, let's say, 5,000 shares. So we are going to say 5 divided by 12 multiplied by that 5,000. We are going to have like 2,000 plus or so. That is what we are going to record it for him, for the sake of calculating the earning per shares. So I believe, do we have any question? We understand the formula. My explanation is very clear, right? So let's move on to solve the questions. So profits after tax. How are we going to get our profit after tax? This is our taxation. This is the profits after tax. Okay, profit after tax. I want to see if we are not making mistake from this our profit, the return on capital employed that we have calculated, that profit before interest and tax. So if it is profit before interest and tax, this is our taxation. Okay, we are correct. Don't let me confuse ourselves. This is what we take. So I believe we take this amount, profit after tax. Okay, let's continue. So this is our profit after tax, and this is what we need. I don't know why I'm having constant network challenge today. Please, let's confirm. Are we together up to this point? All right. That's very good. This is our profit after tax, and this is our, what they call it, our number of ordinary shares. So to get our earning per share, just be, so we have 6.8 So we have 0.675. So that is our earning per shares. And we can, if we want to put it in kobo, we can say we have 67.5 kobo. So this is our earning per shares. So if you want to look our dividend per share, DPS, do we need to put formula? Okay, let me check the formula. Because I'm going to share the workbook with you for your reference. So if you have the formula, it may help. So now total dividend paid to the ordinary shareholders. So based on our question, total dividend paid to ordinary shareholder is 25 to 25,000 divided by a number of ordinary share, which is 1 million. So if we want to find our dividend per share, will be equal to 225 divided by 1 million. So we are going to get 23 kobo. Let me expand the yes, 22. So you can say 22.5 kobo. So this is our dividend per share. Let me put kobo. Kobo. This is our dividend per share. So, and another thing now, all these dividend sharing ratios. If they ask you now, this one is out of the question, that to find the ratio of dividend or the ratio of dividend, yes. Like what is the ratio of dividend? So if to get your ratio of dividend, it will be dividend per share divided by earning per shares. Because I put KK, okay? Dividend per share divided by earning per shares. So this is 3, like 1/3. So this means this company distributing it's 1/3 of its profit as dividend. So this one also is part of another thing when we go to dividend decision making, because different investors invest in company based on their dividend strategies. So for instance, the person that maybe young person like us that want to invest, we are looking for the growth in the future. We may be more concerned about the company that have a growth strategies, that their investment is growing. But for the maybe the retirees, like the pensioners, if they want to invest, so they just want the company that will be giving them constant dividends. So we're going to talk about that on investment decision class. So on this, any question before we move to our last question? Our last question is total return shares, total shareholders return. Are we good? Any question on this? We are moving on. Any question? Okay. So I believe that we are good. So last one, total shareholder return. So we want to know both the growth in shares and the dividend. So what will be the total shareholders returns in the company? So the formula for that is this. So the total shareholder return is equal to price. That is the share price at the beginning of the year minus share price. Okay, share price at the end of the year minus share price at the beginning of the year. So within you will see the growth in shares plus dividend per shares divided by share price at the start multiplied by 100. So we can say our TSR, total shareholder returns, is equal to, in brackets, so our share price at the beginning, share price on January is 15 naira. Share price on December 2024 is 17 naira 25. Okay. At the beginning, we have 15 naira. Minus at the end. Okay, sorry. At the end first, we have 17.25 naira. Minus share price at the beginning, which is 15 naira, in brackets. In brackets, plus we have dividend per shares. So dividend per share during the year is 0.75 plus 0.75. All of them in naira. Let me put naira to this as well. So divided by share price at the start, which is 15 naira. So share price at the start is 15 naira. Then we are going to multiply by 100%. Multiplied by 100%. So that is just simple as that. So if you want to find our distance, I think from this place we can solve it, because I'm going to just use formula. So I will say it's equal to 17.25 minus 15. So if you are pressing your calculator, I will put this in brackets. Then I will say plus, even if I not put them in brackets, since it is not multiplication, then I'm going to put all of them in brackets so that I can divide by 15%, 15 naira. Okay. Do I need to remove? Okay. So I'm going to have 0.20. It's going to give me 20%. So the total shareholders return is 20%. And you can divide this to know what is the percentage of the what is the percentage growth in time of capital gains, and what is the percentage so I think you can also do that to get it. So if you want to get it like that, for the capital gains, we know that there is increase. There is increase of 2.5, 17.25 minus 15. You can say 2.5 divided by 15. You are going to get 15%. So that will be the end of the class for today, and I believe that we have achieved something important. So I will just urge us to revise our book, especially what we have done today. If you have the opportunity to go with to read chapter 1 and 2 of the study test today, so everything they are going to like work together with what we have learned now. I know they are going to stay and stick in your brain. So do we have any question? Any question? Okay. So in the absence of questions, so we are going to adjourn the class and meet in our next class. So thank you so much. I will share the workbook, and once the recorded class is ready, I'm also going to share it in the group. So thank you so much.